All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker BIIB, Biogen, a company we've looked at before on the channel and is a current holding of ours. Just give me a moment to double check a couple settings. We've actually changed a whole lot of things around the audio settings and the video settings for how we're doing the stream, as well as a whole bunch of things around the channel. So hopefully everything's working smoothly. Won't really be able to tell until after the fact, since there's not usually too many people to tell me in real time. So hopefully everything looks and sounds smooth. One moment. Okay, everything looks good. So we're going to get into Biogen, which, like I said, we've covered before on the channel. They have a number of medications, biotech company that works in the neurological space. We bought them ahead of several FDA trials that they were trying to get approval for an Alzheimer's medication that they have developed, Aduhelm. I always kind of have difficulty being certain about how to pronounce that, but this is a medication that they don't really have much revenues for, so it's mostly a future growth prospect for them on the back of several declining revenue streams that they have, such as Spinraza, which they talk about right here at the top of their report, having a pretty significant decline year over year in the most recent year, as well as a few other medications. They're also in multiple sclerosis with the development of various biosimilars in European markets, although they also are developing a few biosimilars themselves in some different markets. So it's a little bit of an interesting situation where there's a lot of uncertainty about the decline in revenues in their legacy drugs versus the ones that they have in the pipeline, as well as since the approvals came out after those meetings that I was purchasing the stock ahead of last year. The stock did jump pretty significantly after the fact, up into the 400s, and then dropped back down pretty significantly after the fact, after a lot more uncertainty developed surrounding these medications. There was a really large price tag put on it, and then there was also some reports of some side effects, and so there's been a lot of uncertainty about just how much it would get coverage in Medicare. And currently there's been some limitations on the amount of coverage they can get, basically limiting it to people who are also in some certain clinical trials. Although they have managed to get $1 million worth of revenues in the first year. Obviously 1 million is not very significant, especially against a 33 or so billion dollar company with about $11 billion in revenues. So yeah, needs to scale up pretty significantly from 1 million, but I would say that $1 million is still a pretty significant start. I have done some interesting projections as far as what I think is potentially possible for these medications, while also taking into account the declines of their other medications. But we'll get into that when we cover the projections for the company in general. I just wanted to kind of mention all of the uncertainties about this drug ahead of time. As with pretty much all of our valuations, I have done all the typical things I do as prep work ahead of time, covering their book value of debt and converting it into a market value of debt. They have 7.7 or so billion dollars in debt if you include lease liabilities. This also is at a 3.53% weighted average interest rate and a 13% weighted average maturity of years, or 13 years of weighted average maturity of that interest rate. They have an unlevered weighted beta of 1.45 because the biotech industry is relatively high risk, which is pretty high relative to the actual market beta that they have of around 0.46 according to Google anyway. So that could explain a lot of that. Doesn't really explain necessarily the pricing. What that does show is a lot of my personal difficulties with the typical beta concept, because if you use beta on an individual company, the company can be declining while the market is moving up, and then it'll give it a low beta, and so that kind of gives you the indication that the company is low risk when perhaps they have pretty significant decline issues involved in the company. Why I like looking at weighted company but level betas based off of industries, so that you actually get an idea of what an industry specific beta is, that tells you what an industry risk is like rather than a company specific risk. So the industry for biotech is pretty high risk. They typically have a low sales capital ratio. This usually comes on the back of pretty high capital investments in R&D, because this is a capital ratio that is adjusted for that, and also a 15.66% net margin, which is pretty decent, but this is actually probably has a really high variance among it, where there's some companies that probably have low and negative margins, while other companies have really significantly high margins. So this number is probably a little bit misleading in that front, because of the fact that there's probably a very high variance. That's kind of the segmentation for the company. We'll see what it looks like after we adjust it for debt. Hopefully it doesn't extend pretty high up, but I think on the old valuation, my cost of equity was around 10%, maybe even close to 11%. So I wouldn't be surprised to see it in that range or even higher, considering interest rates and equity risk premiums are starting to move up as well. But they do have 30% of the revenues coming from Europe, 43% in the US. As I said, the European revenues are particularly at risk of decline. They have German revenues also segmented off separately into 13%, with another 7 to 8% coming from Asia and 6% coming from everywhere else. The US revenues are most likely to have the largest increase in the near future, though I imagine if there's good success with Aduhelm in the US, they will also branch out into European markets a little bit more successfully as well, though perhaps at lower margins. The production is actually more heavily tilted towards European. This company does have a pretty large European base of labor and executive team. The CEO himself, I believe, is French. They are still incorporated in the United States, but there is a pretty large European focus as far as the business goes. So anyway, I did do the first year worth of numbers as I typically do. I'm going to play the fourth quarter earnings call as I work.
Good morning. My name is Madison, and I will be your conference operator today. At this time, I would like to welcome everyone to the Biogen fourth quarter earnings call and financial update. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star 1 on your telephone keypad. Please limit yourself to one question to allow other participants time for questions. If you require any further follow-ups, you may press star 1 again to rejoin the queue. Thank you. I would now like to turn the conference over to Mr. Michael Henke, Head of Investor Relations. Mr. Henke, you may begin your conference.
Good morning, and welcome to Biogen's fourth quarter 2021 earnings call. Before we begin, I encourage everyone to go to the investor section of biogen.com to find the earnings release and related financial tables, including our GAAP financial measures and a reconciliation of the GAAP to non-GAAP financial measures that we will discuss today. Our GAAP financials are provided in tables 1 and 2, and table 4 includes a reconciliation of our GAAP to non-GAAP financial results. We believe non-GAAP financial results better represent the ongoing economics of our business and reflect how we manage the business internally. We have also posted slides on our website that follow the discussions related to this call. I would like to point out that we will be making forward-looking statements which are based on our current expectations and beliefs. These statements are subject to certain risks and uncertainties, and our actual results may differ materially. I encourage you to consult the risk factors discussed in our SEC filings for additional detail. Today, we will be discussing Aduhelm. Aduhelm is indicated for the treatment of Alzheimer's disease. Treatment with Aduhelm should be initiated in patients with mild cognitive impairment or mild dementia stage of disease, the population in which treatment was initiated in clinical trials. There are no safety or effectiveness data on initiating treatment at earlier or later stages of the disease than were studied. This indication is approved under accelerated approval based on reduction in amyloid beta plaques observed in patients treated with Aduhelm. Continued approval for this indication may be contingent upon verification of clinical benefit in a confirmatory trial or trials. Aduhelm can cause serious side effects, including amyloid-related imaging abnormalities, or ARIA. ARIA is a common side effect that does not usually cause any symptoms, but can be serious. Aduhelm can cause serious allergic reactions. The most common side effects include ARIA, headache, and fall. Please see full prescribing information and patient medication guide at aduhelm.com. On today's call, I am joined by our Chief Executive Officer, Michel Vounatsos, Dr. Priya Singhal, Interim Head of Research and Development, and our CFO, Mike McDonnell. We will also be joined for the Q&A portion of our call by Alicia Alaimo, President of our U.S. organization. As a reminder, during the Q&A portion of the call, we kindly ask that you limit yourself to one question. I will now turn the call over to Michel.
Good morning, everyone, and thank you for joining us. I will start by briefly reviewing our financial performance, and Mike will provide more details. For the fourth quarter, Biogen generated approximately $2.7 billion in revenue, representing a decrease of 4% year over year as we continued to experience the erosion of Tecfidera revenue in the U.S. due to the impact of generic entry. Fourth quarter 2021 non-GAAP earnings were $3.39 a share. We believe this performance reinforces Biogen's ability to execute well. However, given a number of challenges we have faced recently, we announced that we will implement cost reduction measures which are expected to yield approximately $500 million in annualized savings, and Mike will provide additional details. Let me now say a few words regarding the proposed national coverage determination, or NCD, for the class of monoclonal antibodies directed against amyloid for the treatment of Alzheimer's disease. As currently written, the proposed NCD calls for coverage with evidence development, or a CED, which will provide reimbursement only for Medicare beneficiaries enrolled in an approved randomized controlled trial. In reaching this proposed recommendation, the Center for Medicare and Medicaid Services, or CMS, highlighted three key areas of focus for this class of therapies, all of which have implications for Aduhelm. First, CMS believes there are gaps in the data on the clinical benefit of these therapies. Second, CMS believes more information is needed about the potential risks of removing amyloid, principally ARIA. And third, CMS would like additional data to be generated on the underrepresented communities in which Alzheimer's disease is more prevalent. These are also areas of focus for Biogen, with many important initiatives already underway. We are committed to...
That's true what he said. The last bit of research I did last night was finding the disproportionate amount of African American and Hispanic patients that have earlier onsets of Alzheimer's than non-Hispanic whites. And the study that they're currently about to do in the next few months, though it's not actually going to get results for several years, unfortunately, is including a little bit higher of a disproportionate percentage of those groups than the typical population, though not quite as disproportionately large as the actual differences for Alzheimer's, I did know, but it's a step in the right direction.
However, we believe the proposed CD requirements will be prohibitive for patients, overly burdensome, costly to companies, and duplicative of the data that will be generated from ongoing trials and the FDA's existing required post-marketing requirements. We believe the best way to address the concerns of CMS is to supplement the data from the Aduhelm phase 3 studies, which generated data over 3,000 patients, by taking a multi-pronged approach, leveraging the phase 4 confirmatory study Envision, our EMBARK redosing study, which has enrolled approximately 1,700 patients, the ongoing iCare AD registry, the ongoing phase 3 studies of other antibodies in the class, and other ongoing and anticipated real-world data generation efforts. We believe this extensive data generation opportunity will adequately address any open question regarding the clinical efficacy and safety of amyloid beta-lowering therapies. On this note, we expect to begin patient screening for the Envision study in May of this year, with a primary completion date anticipated approximately 4 years later.
Yeah, see.
This is expected to be a global placebo-controlled trial.
Good research necessary, but it's not going to
patients with MCI
help the valuation of this stock anytime
or
soon.
mild Alzheimer's disease with confirmation of amyloid beta pathology. The planned primary endpoint will be CDR sum of boxes at 18 months with a planned long-term extension for up to 48 months. We believe this study, combined with the other studies I mentioned, should address the questions raised by CMS. Therefore, we will continue to advocate for an NCD that provides rapid and equitable patient access by providing coverage only for the patients identified as most appropriate for treatment in our FDA-approved label, which generally aligns to our phase 3 clinical trial population. We also believe this multi-pronged approach will allow for more equal access in all communities. We have concerns that the restrictions of the proposed CED would unfairly exclude access for patients in underserved communities and geographically remote areas. In contrast, we expect both Envision and our iCare AD registry, which seeks to enroll up to 6,000 participants, to obtain more representative data from those communities by aiming to enroll 16 to 18% of U.S. participants from Black and Hispanic population. In summary, we will advocate for a final CD that strikes a better balance between patient access for an FDA-approved therapy today and the desire for additional data that can only be gathered over time and with higher levels of drug utilization in the real world. We look forward to discussing this consideration with CMS and working towards a final decision that is in the best interest of patients. Beyond the NCD last quarter, we presented additional data from the Aduhelm phase 3 clinical trial showing the effect on downstream tau Alzheimer's biology and the correlation between plasma p-tau reduction and less cognitive and functional decline. In addition, we published the phase 3 ARIA findings in JAMA Neurology. As we look forward, we aim to expand both within and beyond neuroscience with a focus on 4 pillars to drive growth and value creation. First, we intend as a company to build on our strong foundation in neuroscience, where we currently have 26 programs in clinical development. Second, we have what we believe to be 2 compelling phase 3 programs in lupus. This is a therapeutic area with a different risk profile, and we are continuing to evaluate additional opportunities in specialized immunology. Third, over the last several years, we have also built a very successful new business with our biosimilars. We recently announced an agreement to sell our stake in the Samsung BioEP joint venture to Samsung Biologics, with Biogen remaining in our current role as the commercialization partner for the Samsung BioEP's anti-TNF portfolio and ophthalmology programs.
Okay.
We are currently anticipate.
Yes, I was wondering about whether or not they'd be divesting all their interest against that.
Mid-2022.
They still have a licensing agreement. That's good.
Going forward, we will have an expanded ability to pursue the biosimilars business on our own as we aim to bring more biosimilar product to more patients in more geographies. Mike will provide more details. And lastly, we are also focused on accelerating our efforts in digital health to support our commercial and pipeline programs while also creating opportunities for potential digital therapeutics. To this point, we have built a dedicated digital health portfolio, which includes the recently announced new collaboration with TerraPanacea with the aim of leveraging our significant database, but also machine learning, artificial intelligence, to develop digital health solutions that may improve patient care, accelerate drug development, and further the understanding of underlying pathologies. Our progress across these 4 pillars provides us with the potential for 2 future waves of growth as we launch in new therapeutic areas and build new franchises. First, over the next few years, we believe we have a significant potential in Alzheimer's disease and depression, 2 large therapeutic areas with significant and unmet needs. In Alzheimer's disease, we have a deep pipeline of clinical and preclinical assets, leveraging multiple modalities and targets, including both amyloid and tau. With Aduhelm and lecanemab, Biogen and Eisai have 2 out of the 4 potential anti-amyloid antibody therapies that are either approved or in late-stage development. In depression, we are collaborating with Sage Therapeutics on zuranolone, which we believe has the potential to provide a valuable new option for patients suffering from major depressive disorder and postpartum depression. We believe our second future waves of growth, anticipated in the mid to late 2020s, will be driven by a number of diverse therapeutic areas, including stroke, Parkinson's disease, and lupus, with some of these programs already in phase 3. These anticipated future waves of growth will be supported by our diversified pipeline, which today includes 32 clinical programs, 10 of which are in phase 3 or filed. Additionally, outside of our core business, we are pleased to have recently exercised an option for mosunetuzumab, a late-stage investigational bispecific antibody targeting CD20 and CD3 in development by Genentech for oncology and potentially other indications. Exercise of this option will provide Biogen with a profit share, while Genentech will lead strategy and implementation with an expected FDA filing in the near future. This builds on Biogen and Genentech's long history of productive collaboration, which began with rituximab. Our focus in 2022 will remain on execution and agility as we expect a number of important milestones. This includes the continued launch of Aduhelm in the US, the launch of Vumerity in the EU, and our expected entry into the US biosimilars market with BioViz. We expect 5 data readouts, 3 of which are in phase 3, and the completion of 3 regulatory filings in Alzheimer's disease, depression, and biosimilars. Before I turn the call over to Priya for an update on our progress in R&D, I want to first say how impressed I am by what I have seen from Priya, both as the head of safety and regulatory science and most recently as our acting head of R&D. Her ability to lead, her strategic thinking, and her subject matter expertise give me the utmost confidence in her ability to advance our pipeline while we work to name a permanent successor. Please go ahead, Priya.
Thank you, Michel, and good morning, everyone. First, I want to say what an honor it is to serve as acting head of R&D at Biogen. Biogen has a track record in developing life-changing therapies in MS and SMA. With a deep and diverse R&D pipeline, Biogen aims to bring impactful medicines to patients suffering from neurological and immunological diseases characterized by significant unmet need. As this is my first earnings call within this role, I would like to review a few areas that I'm especially excited about. First, we believe that Biogen has a unique opportunity to lead in Alzheimer's disease, not only because we are advancing an industry-leading Alzheimer's pipeline, but also because of the proactive focus we have placed on continued data generation for aducanumab. This includes ENVISION, the planned post-marketing phase 4 study, the ongoing EMBARK redosing study, and obtaining real-world data through the iCare AD registry. We believe data from patients treated with aducanumab in the real-world settings with greater drug utilization is the
Okay.
best way to complement
That's
the
4
extensive
years.
clinical data generated on aducanumab
Do a
to
5th
date,
year, and then
in
we'll do a
addition to
5-year
the
trend.
ongoing and planned clinical trials. We also continue to gain potential insights from the aducanumab phase 3 clinical data regarding Alzheimer's disease biology and the treatment effect of aducanumab. On this particular point, Biogen recently presented additional data from the Engage and Emerge phase 3 trials at the annual CTAD meeting last November. The important analysis of this data showed that in addition to reducing amyloid plaques in the brain, aducanumab treatment also resulted in changes in downstream tau Alzheimer's disease biology, specifically soluble phospho-tau or p-tau, as seen in both CSF and plasma. In this analysis, we evaluated over 7,000 plasma samples from more than 1,800 subjects from the Emerge and Engage phase 3 trials to investigate the effect of aducanumab treatment on plasma p-tau 181. The results showed a time and dose-dependent reduction in p-tau 181 over 78 weeks with aducanumab treatment in both phase 3 trials. The reduction in plasma p-tau 181 from baseline to week 78 in this analysis was significantly correlated with change in amyloid PET over the same time period and was also significantly associated with less clinical decline across all primary and secondary outcome measures assessing cognition and function in both studies. These findings are consistent with the hypothesis that aggregated forms of amyloid may mediate soluble tau phosphorylation. With regard to our AD pipeline, we are excited about lecanemab, our other anti-amyloid antibody in Alzheimer's disease that is being developed in collaboration with Eisai. In phase 2, lecanemab did not utilize a titration period, demonstrated rapid and robust reduction of amyloid plaques, and showed an ARIA incidence of around 10%. We look forward to the phase 3 readout expected in the second half of this year. Beyond our programs targeting amyloid, we are also pursuing a multimodality approach focused on other targets in Alzheimer's. First, we have BIIB080, which is an ASO that we believe facilitates tau mRNA degradation and has demonstrated both a time and dose-dependent reduction of CSF phospho and total tau in phase 1. We anticipate starting the phase 2 study of BIIB080 by mid-year. Second, we are also planning for the near-term initiation of a phase 1 study for BIIB113, a small molecule inhibitor of O-glycanase or OGA, an enzyme believed to catalyze the removal of O-glycanic post-translational modification of tau protein. Evidence suggests that O-glycanylation of tau attenuates aggregation. By inhibiting OGA, we aim to increase the O-glycanylation of tau to potentially inhibit tau aggregation and thereby slow clinical decline. Having developed the first FDA-approved therapy to address a defining pathology of Alzheimer's, we believe that Biogen is uniquely positioned with the right expertise, experience, and access to modalities to lead in Alzheimer's disease. This is a complex disease requiring a multifaceted approach and continued investment as we work to build on the scientific learnings of ADUHELM and develop the next wave of potential Alzheimer's therapies. I would now like to talk about depression. I believe that zuranolone, with a novel mechanism of action, may provide an important new treatment option for patients suffering from major depressive disorder and postpartum depression. The reported clinical data generated to date from multiple clinical trials showed the following. First, in earlier studies,
All right, not to cut her off before she tells us all about depression, we'll do the 5-year trend here. Taking a look down at the bottom, sales to capital ratio, you can see that they do in fact have a pretty low sales to capital ratio, around 0.6 for around 3 years until through 2019, and then 2020 happened. Excuse me. 2020 happened, took a little dip down 0.52, and then down in 2021 it's down to 0.44. As we've talked about, they have a pretty significant decline in sales over the last couple of years in some of their legacy medications as some competition has come in, and they've also been doing large amounts of research into new medications that has brought their capital base up. So obviously that's pretty easy to explain why that's compressed, but hopefully it starts to springboard back up. Taking a look at their PE ratio throughout the time period, the normal PE, you can see it's kind of stayed a little pretty large amounts of bouncing. It was pretty cheap in some of these time frames, but now it's a bit more expensive. That's partially because the earnings has dropped pretty significantly, but there is at least some confidence that they're going to stay within a certain range. Though we'll get into a lot of the guidance and expectations about that as we move through things. Overall, you can see that the shareholders' equity has come down a bit throughout the overall compression of this, even though the liabilities themselves haven't come up that dramatically. It's just not really translating into actual shareholders' equity, partially because they do have some other non-controlling interests involved. They do have a decent amount of cash, so they have a pretty liquid position to maintain their debt payments, though also their weighted maturity set up as about 13 years, but there's also no major maturities on their debt profile for the next couple of years, if I'm not mistaken. So that's not even really an issue for them. As you can see, returns on equity were pretty good up until this last year. This is a pretty solid trend, minus this one particular year, and the same thing translates on the returns on invested capital. So pretty easy to see why that could easily bounce back. This could just be a fluke year, but it's hard to say since that is dependent on the sales decline that they've had. Looking over the period, their free cash flow to equity has totaled about 14.5 billion, and they've paid out in total to the shareholders 20 billion or so. They have overpaid their shareholders pretty solidly, and you could argue that that's because their stock's at depressed levels, and so it's a good investment, and they have a pretty good cost of debt, and so therefore they can afford to do so. But either way, that does come with its risks. But like I said, that it isn't on the back of over leveraging their debt profile necessarily, assuming that they can maintain at least a decent amount of growth moving forward. Looking at the corrected net margin, this is a little bit illusory, as we've talked about the R&D capitalization effect that still has to build itself through. This being a biotech company, that's going to have a pretty profound effect. So if we just look at the reported net margin for GAAP EPS, you can see it was in 20s, 30s, even 40s up here, and then declined to 30s, and then back down to 14. Again, the industry expectation, they have about the same sales capital ratio as the industry expectation, and the reported net margin in 2021 alone is relatively close to the industry level as well. So they're kind of in the midpoint between a lot of failing companies and a lot of successful companies, like I said, where they could go either direction. It looks like with no interest payments listed here, we're probably gonna have to use the listed value on the book value, but that's okay. So we'll just put that in there right there. But looking at the revenues, as you can see, they had a growth about 9% here, and then 7% there, and then a decline of 6.5% in 2020, followed by a decline of 18% here. So, you know, if you count the fact that they did grow up a little bit, it wasn't so bad in this first year of decline, but this is bringing them back down to levels where I'm pretty sure it's going to be more like where they were in 2014, 2015, or something like that. So anyway, I will continue the call and numbers now.
An improvement in depressive symptoms has been observed as early as day 3. Second, zuranolone has displayed a consistent safety and tolerability profile with no observed evidence of weight gain, sexual dysfunction, euphoria, or increased suicidal ideation. Third, the Shoreline Phase 3 open-label study showed that approximately 80% of patients who responded to the initial course of 50 milligrams of zuranolone needed at most one additional treatment total during their time in the 1-year study. Fourth, in the Waterfall Phase 3 study, zuranolone reduced depressive symptoms in patients suffering from MDD, both with and without elevated anxiety. Fifth, zuranolone has shown improvements in depressive symptoms in postpartum depression. For zuranolone, we look forward to 2 phase 3 readouts this year: the CORAL study in MDD and the SKYLARK study in PPD. The next area I would like to highlight is stroke. Last year, we were excited
even just
by
looking
the
on the
results
reported
of the phase
EPS,
2
you can
study
definitely see
of
why the
BIIB
stock is
131,
having such
formerly
difficulties.
known as TMS
Just on that basis alone,
007, in
it
acute ischemic
looks
stroke.
terrible,
Administration of the current standard of care, pharmacological
and it's only going to get
thrombolytic
darker for them before it gets
CPA,
brighter.
is limited to a short
But I think it'll get
therapeutic
brighter.
window within 4.5 hours following the acute onset of stroke symptoms. This short time window is meant to mitigate the risk of intracranial hemorrhage, which is the most concerning adverse event associated with TPA. In the phase 2A study of BIIB 131, acute stroke patients were randomized to receive BIIB 131 or placebo out to 12 hours from their last known normal. The primary objective of the study was safety, and of the 52 patients who received BIIB 131, none experienced symptomatic intracranial hemorrhage compared to 1 out of the 38 patients who received placebo. This was despite an extended treatment window where patients on average received BIIB 131 at 9.5 hours after the onset of acute stroke symptoms. Additionally, BIIB 131 showed a statistically significant improvement versus placebo on the Modified Rankin Scale, or MRS, a registrational endpoint of functional independence. Furthermore, the rate of recanalization, or improvement of vessel blood flow, in patients who had a visible vessel occlusion was approximately 58% at 24 hours in those who had received BIIB 131 as compared to 27% of patients who received placebo. We believe BIIB 131 may have the potential to be a best-in-class thrombolytic for the treatment of acute ischemic stroke by extending the treatment time window out to 24 hours with an appropriate efficacy and safety profile. We are currently evaluating the next steps in the development for BIIB 131. In addition to BIIB 131, we also continue to advance a phase 3 study for BIIB 93 in large hemispheric infarction, based upon the effects observed on mortality and cerebral edema in the phase 2 study. I would now like to turn my attention to specialized immunology. We currently have 2 phase 3 assets in SLE, including dapirolizumab pegol in collaboration with UCB, and BIIB 59, our anti-BDCA2 antibody developed in-house at Biogen. These 2 assets represent potential first-in-class molecules in SLE. BIIB 59 also has the potential to be a first-in-class biologic in cutaneous lupus erythematosus, or CLE. CLE is a skin-based autoimmune disease that can be associated with severe scarring and dyspigmentation. In the phase 2 LILAC study, the CLE part of the study also met its primary endpoint by demonstrating a dose response of BIIB 59 on the % change from baseline in the CLASI A score, a standardized scale measuring CLE disease activity at week 16 in individuals with CLE. Furthermore, a higher CLASI 50 response rate, or number of individuals with a 50% or greater improvement from baseline in the CLASI A score, was observed in patients who received BIIB 59 at week 16. Based upon these results, we are currently planning to also initiate a pivotal study for BIIB 59 in CLE this year. Next, I will touch upon ALS. ALS has been a very key focus area for Biogen for many years, and we remain encouraged by the data from the phase 3 VALOR study of tofersen, where despite missing the primary endpoint of a statistically significant change from baseline to week 28 in the ALS-FRS, we believe there are trends favoring tofersen across multiple secondary and exploratory measures of biological and clinical activity. We are continuing to collect data in the VALOR open label extension, and we are actively recruiting for the ATLAS pre-symptomatic study. Many SOD1 ALS patients have received access to tofersen through the Global Expanded Access Program, which is available in countries where local regulations permit it and where we hope to secure long-term access. Further, we are engaged with regulators to determine the next steps for the program. Aside from the areas I've highlighted, Biogen continues to grow and diversify the R&D pipeline, which now includes 32 clinical programs. New additions include the exercise of the option with Ionis on BIIB115 and investigational
Have you heard that they have 32
ASO
clinical programs?
with the potential for
I hear that
extended
they have
dosing
32
intervals
clinical
in
programs.
SMA, as well as the recent initiation of
I
a
kind of
phase
laugh
1
when people
study
say
in
things
Angelman
over and over and
syndrome,
over again.
a rare genetic neurodevelopmental disorder that affects the nervous system and causes severe physical and learning disabilities with symptoms beginning in infancy. Importantly, I believe that 2022 will be a significant year for Biogen's pipeline given the number of important readouts expected, including the lecanemab phase 3 in Alzheimer's disease, key readouts in neuropsychiatry for both zuranolone in depression and BIIB104 in schizophrenia, and BIIB78 in ALS. In closing, I believe Biogen has assembled an extensive pipeline of programs informed by genetics, a deep understanding of disease biology, specialized modality expertise, and digitalization. Therefore, I believe Biogen is uniquely positioned to shape the future of therapeutics in neurology and specialized immunology and make a difference in patients and their caregivers' lives. I will now pass the call over to Mike.
Thank you, Priya, and good morning, everyone. Thank you for joining us. I'll focus my commentary on fourth quarter results along with some discussion regarding the full year 2021. Total revenue for the fourth quarter of $2.7 billion declined 4% versus the prior year at both actual and constant currency. Total revenue for the full year of $11 billion declined 18% versus the prior year at actual currency and 19% at constant currency. This decline was mostly driven by Tecfidera generic entry in the United States. Non-GAAP diluted earnings per share in the fourth quarter was $3.39. Full year non-GAAP diluted earnings per share was $19.22. Total MS revenue, inclusive of Ocrevus royalties in the fourth quarter, was $1.8 billion. Global Tecfidera revenue in the fourth quarter was $486 million. U.S. revenue was $161 million. Outside of the U.S., Tecfidera revenue of $326 million increased by 13% versus the prior year, with 7% growth in underlying patients. Vumerity fourth quarter global revenue was $125 million as compared to $39 million in the fourth quarter of 2020. We expect Vumerity to continue to grow both in the U.S. and outside the U.S. Tysabri fourth quarter global revenue of $513 million increased 8% versus the prior year, benefiting from positive channel dynamics in the U.S., and we were pleased to see continued global patient growth. Moving to SMA, global fourth quarter Spinraza revenue of $441 million decreased 12% versus the prior year. In the U.S., Spinraza revenue of $150 million decreased by 6% versus the prior year, as we saw continued impact from competition. However, we were encouraged to see that discontinuations moderated somewhat versus Q3 of this year. U.S. Spinraza revenue increased 7% versus the prior quarter, inclusive of some favorable pricing and channel dynamics. Outside the U.S., Spinraza revenue of $291 million decreased 14% versus the prior year due to competition and pricing pressure. We continue to believe that Spinraza can return to growth over the medium to long term. Total Aduhelm revenue for the fourth quarter was $1 million. Moving to our biosimilars business, fourth quarter revenue of $221 million increased 12% versus the prior year, with increased volume partially offset by pricing pressure. Our Q4 biosimilars revenue benefited from a one-time price adjustment of approximately $10 million. Last week, we announced that we have entered into an agreement to sell our equity stake in our biosimilar joint venture, Samsung Bioepis to Samsung Biologics for aggregate consideration of up to $2.3 billion. We believe this represents an attractive financial return given that our cumulative investment in the joint venture was $727 million.
We confirmed that 500 million of that was in the cash flow statement, so 200 million was probably in equity.
And Flixabi, with economics that will be substantially unchanged from what you have seen previously. So we are pleased with this transaction because we not only maintain the commercialization rights that we have, but we will also have an expanded ability to pursue additional biosimilars products on our own going forward. Closing of this transaction is currently anticipated in mid-2022, contingent on the effectiveness of a securities registration statement filed by Samsung Biologics and satisfaction of certain regulatory and other customary closing conditions. Total anti-CD20 revenue in the fourth quarter of $414 million decreased 1% versus the prior year. Rituxan revenue of $153 million decreased 29% versus the prior year due to the impacts of COVID-19 and continued erosion from biosimilar competition. Ocrevus royalty revenue of $261 million increased 29% versus the prior year. As a reminder, the effective royalty rate for Ocrevus royalties resets each calendar year. Fourth quarter gross margin was 76% of revenue, down from 83% in Q4 of 2020. The reduction in gross margin versus prior year was primarily due to a $164 million charge for Aduhelm inventory and purchase commitments in excess of forecasted demand. Moving now to expenses in the balance sheet. Q4 non-GAAP R&D expense was $700 million, which includes a $60 million opt-in payment to Ionis for BIIB 115 and a cost of approximately $50 million for the exercise of our option with Genentech for the bispecific antibody mentioned earlier. We will share in the operating profits and losses for this program in the low to mid 30% range in the United States. Non-GAAP SG&A was $785 million, including approximately $155 million related to Aduhelm. Eisai's reimbursement of U.S. SG&A costs of approximately $45 million is reflected in the collaboration profit sharing line. Fourth quarter collaboration profit sharing reduced our net operating expense by $67 million, which includes reimbursement of approximately $140 million from Eisai related to Aduhelm commercialization, partially offset by $75 million of net profit sharing expense related to our collaboration with Samsung Bioepis. During Q4 of this year, our effective non-GAAP tax rate was approximately 17%. During 2021, we repurchased approximately 6 million shares of our common stock for a total value of $1.8 billion. No shares were repurchased in the fourth quarter of 2021. As of December 31st, 2021, there was $2.8 billion remaining under the share repurchase program, which was authorized in October of 2020. Our weighted average diluted share count was approximately 147 million shares for the fourth quarter. In 2021, we generated approximately $3.6 billion in cash flow from operations. Capital expenditures were $258 million, and free cash flow was approximately $3.4 billion. We ended the year with $7.3 billion in debt, $4.7 billion in cash and marketable securities, and $2.6 billion in net debt. In addition, our $1 billion revolving credit facility was undrawn as of the end of the year. Overall, we remain in a very strong financial position with significant cash and financial capacity to grow the business over the long term. Let me now turn to our full year guidance for 2022. We expect full year 2022 revenue to be between $9.7 billion and $10 billion. This financial guidance assumes minimal Aduhelm revenue in 2022, continued declines in Rituxan revenue due to biosimilar competition, as well as continued erosion of Tecfidera revenue in the U.S. due to generic entry. This guidance also assumes the potential entry of Tecfidera generics in the EU as early as the first half of 2022, as the outcome of the ongoing challenges to Tecfidera market protection is difficult to predict. We expect the decreased revenue from these high margin products to reduce our gross margin percentage as compared to 2021. We expect full year 2022 non-GAAP diluted EPS to be between $14.25 and $16. Our guidance assumptions are highly dependent on the final national coverage determination, which is currently uncertain. If the final NCD, which is expected in April, is not broader than the draft NCD, our anticipated results and guidance may be impacted. This guidance assumes that we will not have any write-offs of Aduhelm inventory in 2022, which is valued at approximately $225 million as of the end of 2021. This guidance also assumes reasonable levels of utilization of our manufacturing capacity dedicated to our Alzheimer's disease programs. If our manufacturing capacity is underutilized, we will incur incremental period costs which are not reflected in our guidance. We expect non-GAAP R&D expense to be between $2.2 billion and $2.3 billion, and our non-GAAP SG&A expense to be between $2.5 billion and $2.6 billion. This non-GAAP SG&A expense estimate includes approximately $400 million in support of the launch of Aduhelm, of which approximately $145 million would be reimbursable by Eisai and reflected in the collaboration profit-sharing line. These R&D and SG&A expense estimates reflect the implementation of previously disclosed cost reduction measures, which are expected to yield approximately $500 million in annualized savings, of which approximately $350 million is expected to be realized in 2022. These savings are expected to be achieved through various initiatives, which may include downsizing of our global Alzheimer's infrastructure, the savings from which would be shared with Eisai, and operating efficiency gains across SG&A and R&D. These savings are expected to be offset by approximately $200 million in additional investments in our pipeline and strategic initiatives. In the event of a final NCD that is not broader than the draft NCD, we anticipate taking further cost reduction measures, which are not reflected in our guidance, to further align our cost base with our revenue base. Some of the savings from these further cost reduction measures would be shared with Eisai. We expect our non-GAAP tax rate for 2022 to be between 15.5% and 16.5%, and we assume that we will utilize a portion of the remaining share repurchase authorization of $2.8 billion throughout the year, although this will depend on a variety of factors, including our business development activities. Foreign exchange rates as of December 31st, 2021 are assumed to remain in effect for the year. Net of hedging activities, we have not included any impact from potential acquisitions or large business development transactions, as both are hard to predict, or any impact of potential tax or healthcare reform. I will now turn the call back over to Michel for his closing remarks.
Thank you, Mike. In summary, 2021 was an eventful year for Biogen. Aduhelm is now the first FDA-approved treatment targeting a defining pathology of Alzheimer's disease. But as we all know, this is a complex disease which will require continued investment in research over the years to come. Aduhelm is an important first step, and we remain focused on advancing our leading portfolio with the goal of further addressing the remaining unmet needs for patients. We hope that over time we'll be able to bring additional impactful treatment options which will build on the scientific learnings from Aduhelm, similar to the waves of innovation we have seen in oncology. Before I conclude, let me touch on Biogen's strong commitment to corporate responsibility, climate, health, and equity are deeply interrelated challenges that demand bold action, and that's why we are working to advance a healthier, more sustainable, and equitable world. Through our signature initiative, Healthy Climate, Healthy Lives, and other efforts, our goal is to create new ways of doing business that positively impact the way we live and the way we deliver for patients. We are proud that our leadership actions and transparency in this area has been recognized recently by the Dow Jones Sustainability World Index, Corporate Knights Global 100, and Just 100. Through this work, we aim to create shareholder value by meeting the needs of our patients, employees, the environment, and the communities we serve. In closing, I would like to reiterate that we are committed to engaging with CMS and
now
other
on to the last
stakeholders
year.
with the hope of finding an appropriate path forward for the patients in access of Aduhelm. We will now open the call for questions.
Thank you. If you would like to ask a question, please press star one.
I guess we're not going to hear too many of the questions since
As a
we're almost
reminder,
done,
please
but
limit yourself to one question. If you require any further follow-ups, you may press star one again to rejoin the queue. Your first question comes from the line of Robyn Karnauskas with Truist Securities.
Given the recent deal that you did with Sangamo, Samsung, you now have more cash. Could you just talk a little bit about your thoughts on how you might want to utilize that cash? And is that was there a near-term acquisition or things that you're looking at, or is it just something that gives you optionality? Thanks.
Thanks for the question. As you know, we have a strong balance sheet, and we are continuously looking at how we can deliver long-term shareholder value. So we are actively working on some business development opportunities to enrich our pipeline, complement our portfolio in line with our strategy.
right, there's the end
and
of
we will look
the
at the deals based on their
income
own
statement.
merit, and we are working on that.
I'll just add to that, Robyn. I mean, as we said in our prepared remarks, we're pleased with the transaction. It represents a very attractive return relative to the capital that we invested. And the first priority will be to get the transaction closed. As you saw in the release around the deal, the proceeds will come in gradually over time. And so the first priority would be to get the transaction closed, and we'll continue to explore, all of our options around BD, deals of all sizes, and we will continue our share buyback program as well. And, the pipeline remains robust. We look at a lot of opportunities, and, we have an extremely healthy balance sheet, as Michel said, and this will only make it healthier.
And Robyn, if I may, an important consideration is now we can create more value with our biosimilars portfolio. More products, more geographies.
Okay, we'll go ahead and take our next question from Michael Yee with Jefferies.
All right, and the final balance sheet.
Thank you. Good morning. I guess my question is in regards to Aduhelm, what you are actively doing to try and change the NCD decision, and again, to reiterate, if it's not changed dramatically, you guys would look to further cut expenses. So can you talk about what that would entail and under what scenario that might change? For example, if BAN was positive, maybe just outline the thoughts and the roadmap for Aduhelm in 2022. Thank you.
Thank you, Mike. I will get started, and then my colleagues will come in. First of all, we take into account with a lot of caution all the areas of focus that CMS has communicated. And based on those, we look at all the initiatives on the way in order to scientifically fulfill the question they have, being on the benefits risk, being on area, being on disparity. And we have a lot going on from interventional studies, Embark and Envision on top of the phase 3. And now the time together with CMS to engage into a broad real-world evidence set of initiatives already on the way, like AllCare AD, but we are contemplating even more. That could be a disease registry and more. So we are engaging with CMS constructively, demonstrating empathy, to try to find the path forward that will be the best for patients. Alicia?
Yes, thank you, Michel, and hello, Michael. Thank you for the question. In regards to what we've been doing as an organization, during the past 3 weeks, we have met with CMS to share our perspective and answer any of the questions that they have. And you will see that we'll be submitting our in-depth comments in the coming days, obviously during this comment period. In parallel, we've also been educating physicians and policymakers and advocates about what this would actually mean for patients. I think a lot of people, as you've seen, have been quite confused by the draft NCD and what a CED actually means to them. And as you've likely seen, many stakeholders have had similar concerns. So we've seen patients, patient advocates, HCPs, other manufacturers, and industry groups like bio and pharma also sharing their perspectives quite publicly. And there is 1 week remaining for the open comment period, and we are very much looking forward to this final decision in April so that the community has more clarity. And that brings me now to the comment period, where you may have seen over, I think as of today, it's around 2,700 public comments
submitted to CMS, and again, with still 1 week remaining. I think it's important for everyone to remember and to keep in mind that CMS indicates on their website that the most helpful comments are ones that cite published clinical evidence. And when you actually separate the comments out from the dementia specialists, you will see that many of them are against this draft NCD. With prior comment periods, we have seen that in the final days, you tend to see more letters that are heavily researched and referenced. And as I've said before, you will see ours being posted in the coming days. So we do remain engaged actively with all stakeholders. We do remain engaged, obviously, still with CMS, and we are looking forward to the final decision in April.
And so, Mike, in your question on the cost measures, as we said in our prepared remarks, our guidance does assume that the final NCD would allow for meaningful patient access over time. That does not translate into material revenue in 2022, but it would create a more open access than what we saw in the draft. Should that not be the case, we are doing scenario planning now on the cost measures. We mentioned our plan of a $500 million cost measure, of which we estimate we will get $350 million in 2022, which is assumed in our guidance, and we will invest about $200 million of that in a variety of different initiatives, including product launches. And in the event that we have a much more restrictive NCD, we will need to look at the elements of that. We certainly will be flexible in looking at allocating resources between Aduhelm and lecanemab. We mentioned in our SG&A, it's assumed that we have a $400 million Aduhelm support estimate, and we obviously would take a hard look at that, as well as other costs we could take out in order to offset any potential impacts on inventory, potential write-downs, and excess capacity charges, which are not reflected in our guidance.
And Mike, as a closing comment, if I may, as a company, we are fully committed to deliver on this data, being the interventional study, being the real-world ones. And we believe that this extensive data generation will adequately address any open question raised by CMS.
And we'll go ahead and take our next question from Matthew Harrison with Morgan Stanley.
Great. Good morning. Thanks for taking the question. I was hoping you could just clarify on the Tecfidera EU contribution to guidance and what we're going to learn this year, which may either help us understand if that revenue is at risk this year, or if you could continue to expect to see it, and that could be potential upside to your current guidance. Thanks.
Sure, Matthew. Thanks for the question. And there is we believe there is the potential for generic entry at some point in the first half of 2022. We do believe that we're entitled to market protection, and we're certainly going to do all we can to assert that. But we did reflect in our guidance, as we mentioned in our opening remarks and in our press release, that we do assume that there could be some generic entry somewhere in the first half of 2022.
So this is assumption driven. At the same time, for tech, at the same time, as already communicated, we are launching Vumerity in 20 markets within the EU.
And we'll go ahead and take our next question from Umer Raffat with Evercore ISI.
Hi, guys. Thanks for taking my question. I wanted to focus on BAN2401 for a second, and really just two questions there. One, can you help us understand the magnitude of missed doses in the phase 3? Because I recall you increased the sample size by 200 patients, and I wonder if that percentage increase versus the original sample size reflects the amount of missed doses. And secondly, the primary analysis, is that ITT, or will that screen out the rapid progressors or certain subsets of patients based on some of the learnings from Aduhelm? Thank you very much.
Priya?
All right, we'll cut it there. Sorry, I had to do one last little thing after I finished the numbers, which is working on this little thing because I realized one problem I had with this little pricing model I built for the revenues that we'll hop into here in a second here. So it can sort of be seen, but we will cover the financial history as we typically do, starting with the sales capital ratio, although it does look like it's needed. Weird. for a second. Anyway, so if you look over their history, the sales to capital ratio is pretty low, as I was saying, kind of in the 50s, 60s area, a little bit higher than their industrial average, I think which was in like the 40s or something. Was it 47 with 15% for the net margin grouping. So, you know, a little bit better than net margin, or a little bit better than industrial grouping, although now it looks like they're trailing a little bit closer to their industrial grouping now. So we'll see if they can actually push back up on that. Like I said, it is because of a pretty significant sales decline, so that has to kind of be moderated to a degree. And if we look at their Mikey, tail up. Here, go. In my way. If we look at their balance sheet over the entire period, you can see that it is pretty well managed. Their overall liabilities have gone up pretty dramatically. It's 4x over this time frame, with the assets only going 2.5x. So overall, the equity has come down pretty solidly. Again, they peaked in the revenue several years ago, so it is down from those peak levels, and that needs to, whether or not that's actually going to return to its peak, back to its peak, is the real question. But like I said, I kind of have a revenue modeling that we'll get into, where whenever they do have top peak revenues, they do have pretty high returns on invested capital. Looking at their cash flow, as I was saying with the 5-year trend, they were overpaying on the whole, and that's pretty much true over the 10-year period. It's still almost $28 billion that they've had for their equity investors, but over the entire period, it's still a little bit more than that, though not as bad in that time period. It's now 28.1 billion, so it's only just barely overpaid over the 10-year period. So most of the overpaying has come in the last 5 years. The overall adjusted net capex, which is all the capex after adjust for the R&D, shows that the largest amounts of their capital expenditures were actually a few years ago. And 2020 was pretty large as well, but in 2021 it was actually technically more of a liquefying year, possibly because of the selling off of their strategic investments, as what they were talking about in their earnings call. You can see the peak net margins were around top 30s were 40%, because we can't really go back further than 5 or 6 years due to the R&D capitalization effect. But in the most recent year, it's down closer to these teens, which is closer to the more typical time frame. Mikey, stop it. I don't know why my cat is being such a brat. You can't just like sit still for a little bit. So anyway, I'm getting into my pricing model for this. There's been a lot of drama surrounding the pricing of the Aduhelm drug, which initially came out with a price tag around like $58,000 or $56,000 per year per patient, and then it's been slashed down to $28,000, and because of the backlash on that. Now Medicare is going to be their primary customer, which is why these price slashes matter, because what Medicare is willing to pay is basically what their entire customer base is going to be willing to pay. Now, according to the CDC website, there is about 5.8 million US people over the age of 65 with Alzheimer's. I'm making kind of an arbitrary number to define 10% of them as early stage. That part's totally arbitrary. There's a lot of little arbitrary bits in here, but we can kind of argue about that all you want. I do adjust for the uncertainties later on, so we'll get to that. Just assume 10% is the early onset of grouping. They also have on the CDC website the belief that in 2060 there's going to be 14 million. Based off that implies a 2.23% CAGR over the entire 40-year period, and so based off that, I can project a 6.8 million in 2027, which is 5 years from now. And then 10% of that gets me 676 or 677,000 patients. Now, there's going to be a large amount of people that are not going to go for treatment. There's also going to be a large amount of people that they don't get into the market share, but we'll get into that. Now, I have a best case and a worst case scenario here. So in the best case scenario, we go with the price that it's currently at, which is 28,000. And we assume that they can actually have pretty significant price growth in the future, because the drug is actually very successful and the effects of it are shown to be mild. So let's assume a best case scenario with 15% growth in the price over the time frame, which gets us to a peak price of 56,000 or so in the 5-year forward period. Based off that, we can assume that there's going to be about $38 billion worth of revenues in this in total market, assuming that they had a total market share of all those people. However, we're going to only assume in the best case scenario that they get a 25% market share, which turns out to be $9.5 billion in the 2027 period. Now they also have all their legacy revenues, which we're going to assume in the best case scenario is going to decline 5%. It could do much better than that. It could, and it can do worse than that, but we have a worst case scenario that we're going to. In the best case scenario, we're still going to assume, well, oh, my bad, not decline. We're assuming this is positive 5, because over here you can see it's a negative. In the best case scenario, we're actually assuming that their legacy business doesn't decline and actually grows by 5%. My bad, that's what it was. And if that happens, that gets us to $14 billion in revenue for those revenues. If you combine the two together, you end up with $23.5 billion of revenues. And then I adjust based off of my uncertainty on these estimates I just knock 25% off. So based off of that estimate, my best case scenario, after adjusting for my uncertainty, I get to $17.6 billion for revenues for Biogen in 2027. That's a best case scenario. Now in the worst case scenario, I assume that they have to slash their price again by 50% first to 14,000. And then I also assume that the drug is not as nearly as effective as they hope. And based off that they actually have to decline the price even more each year by 5% per year for the next 5 years. And that gets me to a price of 10,000, 11,000 in the 5-year forward period. That gets me to total market revenue potential of 7.3 billion. But we're actually going to assume that in this worst case scenario that they only get 5% of that market. That ends up with $366 million of revenue. And then the legacy business in the worst case scenario, we're going to assume declines at 10% per year. And then that ends up getting them to $6.4 billion in revenue. Combine the two, you end up with $6.85 billion. And then I'm going to actually be extra uncertain about this and just assume that this could even be worst case scenario than the best case scenario. And I'm going to chop off 50% rather than 25%. And that gets me to a worst case scenario revenue of $3.4 billion. So these are going to be the revenue targets I'm going to use to project for Biogen: 3.4 billion and 17.6 billion for our projections. We will get to that part when we adjust for a few other factors. First, we're going to go down here and look at some things. As I usually like to do, I like to look at the what the debt to equity ratio ended up being, which is around 23%. And that gets us to a cost of equity, like I said, up northward of 11% because the beta is 1.72. That gets us to a cost of capital of 8.83% because it is mostly equity. So if we 23%, we can assume 0% as the best case scenario, but the worst case scenario, whether or not it's 100%, I'm not so certain about, because if it's $33 billion today, if we assume maybe 33% of the market disappears, or even half of it, so down to 20 or 15 billion, well, they still only have less than 8 billion today. So even if they doubled it and they got cut in half, that would be 100%. But if they doubled it and got cut in a third, that would still only be like 75% or even less. And then with probabilities, it'll probably tilt even further away from this. But I could assume maybe 20 or 15% for the analyst number, which gets us to a projected level of 34. Maybe go a little bit lower than that, 60. Okay, so that gets us 27. We'll start with that right there for the time being, and then we'll go put our projected numbers in here just to get, since we actually have a target of what we want to aim for. Let's see, so we wanted 3.4 billion. That's gonna get it. Oops, that's a really large number. Okay, so a little bit more than that. Let's try 14. 16 is pretty low after all. All right, that's close enough. And then the best case is kind of already in line with it. We will heavily tilt these things for probabilities, however, so that's what we're going to do. For the analyst projected number, we'll go ahead and leave it at 5, I guess. Now for the probabilities, yeah, we're definitely going to heavily tilt these things away, but we're also going to tilt more into the middle. Is that right? Did I count right? I did not. Now, there's still a lot of things to adjust for this because we have to do the net income margin, which is way too low. As you can see, after capitalizing all the R&D, we end up with a net margin for the last 3 years of 32%. If we go for 5 years, which is the entire time frame that we have the capitalized R&D period, we still end up with around 30%. So it's basically not really shifted over that time frame just because we've had some up and down years. But if we assume that in the worst case scenario, it goes down to a pretty low level, down to the industrial grouping level, or even below that, maybe 10% as the lowest case, maybe 5% could be a worst case scenario for it. But the best case scenario has to be up closer to some of these high end levels that it's had historically, perhaps around 40%, maybe even 45%. So that's going to have a pretty huge effect. And then we also have to adjust this as well. Let's see here. So after we dealt with the probabilities, that led the debt to equity to 26%. Maybe we'll have to leave this down at 50. Oh, we need to adjust the sales to capital ratio, which is at 50. I'm just going to bring it back up to 55. So that's an assumption that it actually does move back upward over the period. Probably will tilt a little more towards the optimistic end of things. Let's see, so how does that actually match up the margins against the revenues? That's the part I need to sort of make sure makes sense. -5% with a 27, that matches up pretty well. 36 with a little bit of growth, that matches up pretty well. It leaves the projected returns on invested capital at 14 against the current 3-year average of 17.61, so it was higher than the most recent year, but it would be lower than some of the better, more recent years before that. That checks out. So, what's their tax rate at? 19%. That's fine. I don't need to adjust that. I mean, let's see, so 50% on the 5% decline and 20% on just a little bit of the gain. See, like this moderate better case is just so much only moderate better that you really can afford to put a little bit more weight into it. It's like I feel like I am punishing them a little bit too much with this like super negative revenue disbursement. I'm fine with like leaving the margin super tilted that way, but there needs to be, I think, a little bit more of a balance back towards that. But either way, I mean, you can still see how the stock still maintains pretty good value even with a decent amount of decline potential. You can decline both revenues and in margins and still be a forward returning item, though it does have some serious decline potentials too in some of those worst case scenarios. But if the drug is even moderately successful, this is a very high returning opportunity. Kind of wish they would stop doing the share buyback personally. It's like if the drug is really successful, those will really pay off. But if it just makes that whole situation even more high risk. Let's see. Is there anything else I want to do? Is this everything? Where did that end up at 21% against the 23 they're currently at? I'm okay with that. Might just be the defaults, and that's it. So, I mean, as I said, this is a company that we currently hold, which is one of the reasons I'm happy that I did it really quickly rather than some of the other bigger mega caps that also reported this week, because I was buying a little bit of this one only not too long ago, in which, I mean, obviously it still looks like it's undervalued a bit, but and the returns are good, but my previous valuation didn't have it appearing even slightly better, so it comes out that way. Yeah, you know, we've been going for a while. Thanks for showing up when you do. Of course, you can always replay it. Or check out other ones. Please like if you're watching and enjoying the stream. So we will do the adjustment for the default risk, and then we can do the summary of the valuation, and then we'll cover what we are going to do next. Okay, so for this one, we'll say it's 4.05%. No, I didn't check the. Okay. All right, so that does that. So this is Biogen, ticker BIIB. The U.S. Treasury is currently selling at 1.916%. Wow, it's pretty interesting to see that it's up to that level. And the mature market equity risk premium I currently get is 4.86%, which that is also starting to climb back up pretty high. So it's interesting to see both of these two climbing together. The expected return on the market I currently get is up to 6.78%, which is a little bit higher than it's been for a while. So it's interesting to see. But either way, the discount rate for Biogen that I come up with is 11.44%. They do not pay any dividend. 5 years ago, they had sales of $11.4 billion against the sales in the most recent year of $10.9 billion, which means they had sales growth of almost negative 1% per year for the last 5 years. They've had sales to capital ratio for the last 3 years on average of 0.52 against their industry, which is 0.47, so a little bit higher than their industry, with returns on invested capital of 17.61% for the last 3 years on average, and their current debt to equity ratio is 23.34%. The default risk that they had in the most recent year is around 1%, and the profit margins that they have had in the 3 years, for the last 3 years on average, is around 32%. Those are R&D capitalized adjusted profit margins. Their industry, however, have only had about 15% for that same metric. So for both sales to capital ratio and profit margins, they're a little bit higher than their industrial average, which is generally indicative of a high quality business. The profit in the most recent year was $1.37 billion after adjusting for R&D, and they're currently selling for $221.53. So for our probability distribution, we have a very kind of oddly dispersed set of probabilities, with most of the weight in the middle or tilted towards the slightly more optimistic fourth model, with only 5% in some of the side models and the usual standard 15% in our analyst model. So it's a kind of a weird tailed probability distribution that we're using for this company. And the revenues that we project for the company, it goes from a worst case scenario of $3.5 billion to a best case scenario of $17.6 billion, heavily dependent on the FDA approvals and Medicare approvals of their Aduhelm drug, and the declines of their other drugs and the growth of their other opportunities as well. But either way, on an expected basis, we come to a revenue projection of $10.3 billion, which is on an expected basis a negative 2% per year for the next 5 years. We have sales to capital ratio expectations of 0.56, so we do believe that they will push that back up to their historical levels approximately. But we do believe the returns on invested capital will decline approximately to 14 to 15% or so, a little bit of decline from their more recent history. Their debt to equity ratio we expect to stay in the 20 range, perhaps declining around to 21% on an expected basis. And we do expect their default risk to be pretty negligible over the period, other than in the worst case scenarios, less than 1% per year. So no big deal there. Their R&D adjusted profit margins on an expected basis, we have a wide range projections of anywhere from 10% to 45%, depending on those outcomes that we were talking about. On an expected basis, perhaps around 30%. And that gets us profit margin expectations of anywhere from a worst case scenario of only 360 million to possibly close to 8 billion in the best case scenario, perhaps around 3.3 billion on a projected basis. Our present value projection is $236.91 after using the discount rate that we have, which makes them about 7% undervalued currently. We have 5-year forward value targets unadjusted for any dividends that they could pay out during the period, giving us a worst case scenario of $131.50 in the 5-year forward period to a best case scenario of $870.37. On an expected basis, we would project about $400.07 or $407.14, which compared to the price that they're currently selling at gets us an implied return of 12.94% per year for the next 5 years. So pretty decent forward returns. Not as good as my last valuation of them, definitely. So definitely some of the results of Valuation has affected my own projections of them. I could say that I've gotten a little bit more pessimistic on some of the worst case potentialities for them, though I'm still reasonably optimistic that those worst case scenarios are not very likely. It is a pretty decent sized position of mine. Like I said, I was more optimistic about buying it before doing this valuation, and I'm now less optimistic of buying more, but I'm also not so pessimistic that I'm about to go sell it or anything. Definitely still holding for the time frame and any time in the near future. The value score that we come up with our little in-house valuation metric using some qualitative metrics like sales to capital ratio, returns on invested capital, and profit margins, gets us a score of 0.92, which is not too shabby at all. It's generally a pretty good score, but over 1's generally a really good score. A current one standard deviation up is 1.15. Yeah, no, I'm 13%. It's not bad at all. Definitely market beating. Like I said, my market expectation is 6.78%. That's what I expect the S&P 500 to do for the next 5 years, personally. So when I say 13%, I'm comparing it to that about 7% that I'm expecting for the market. So yeah, definitely not bad at all. Not bad at all, but a huge variation in the potential outcomes. That's just the thing. But I mean, it's not too bad. Like I said, I mean, it can have a pretty significant decline, like this negative 5% decline in revenues, and decline from 32% margins down to 27%. It could do that and still get you to $313 5 years from now, you know, which would only be about a 7% return. But under those decline circumstances, it still values out that way pretty good. So yeah, like I said, I'm not selling it anytime soon, but perhaps maybe not as quick to buy as much more, but that's partially just because of how big it is in my portfolio already. If you don't already own it, it could be a good addition. The short-term pricing metrics that I have here, which takes their current multiples as well as certain fundamental metrics and compares it to the multiples of the S&P 500 and projects out multiples that it would trade on if it was trading similarly to other companies, gets us a suggested price of around $430. So on multiple base metrics, it's extremely undervalued. However, I would argue that biotech as a industry typically trades pretty cheaply based off of market multiples. So I don't, like I said, this is usually a kind of icing on the cake thing I like to look at that suggests that it's very undervalued in like a short-term sense, but this is suggestive that it's undervalued in a long-term sense. So that's gonna do it for Biogen today. Taking a look at our watch list, and the kind of little schedule of companies that I've come up with for the earnings season that we're looking at, I can say that I already know for a fact that Facebook and Google have already released their 10Ks. Both of them, I was preparing to make my valuation today on Google, and then I saw that Facebook had put their 10K out, and I was like, oh, well, maybe I'll do Facebook instead. And then I looked and I saw Biogen had, and since Biogen is my holding, I was like, well, we better do my holding first, and just to make sure we have a good idea of what we're currently holding. So I'm probably going to do another company tomorrow, because like I said, during this earnings season, I'm trying to do a few extra streams. So I plan to stream tomorrow, and I'm probably going to be doing Google. And then on Monday, I think I'm probably gonna do Facebook, unless maybe Amazon releases their 10K over the weekend too, because I know they reported earnings. So whether or not their 10K got released is the question. Or AbbVie. I think AbbVie also put their 10K out. So actually, I probably would do AbbVie on Monday instead, because that's also my holding. So tomorrow is almost certainly going to be Google, and then Monday probably AbbVie. But either way, thanks for joining us live. Hope you can be there for most of it next time, though it is worth noting that technically a lot of the stream in the middle is pretty boring. So really the beginning and the ending is really the parts you kind of want to show up for, just being honest. But yeah, so we stream typically Mondays, Fridays around the time the market closes, though like I said, for the next few weeks we'll probably be adding a Saturday 2 p.m. time frame as well in there. Please subscribe to the channel if you're not already, and like the video if you enjoy in-depth valuation content like this. I'll catch you all